We have seen the biggest red day in the market in a month since the lows of April, with the market supposedly unexpectedly tanking 1.5% today. Now, I was clowned immediately in my last video, which I did for you guys on Sunday, telling you what I expected from the downgrade. The news in and of itself was just one piece of news, but remember that fundamentals just give technicals the excuse to play out. And although I received a bunch of comments, some of them saying this didn't age well or how did your puts play out, puts actually played out kind of fire today, not gonna lie. The market, both the S&P 500 and the NASDAQ, have broken structure on the high time frame for the first time since that April 9th pause. This is the high time frame structure that we broke. You can see here on the 4-hour, we broke below that last higher low. And there are tons of opportunities to be had from this. I was actually waiting on this exact setup to break high time frame structure, not only to look for buy points on stocks and options, but like I said, there is a continuation short. So where is the market going? What the hell happened between Sunday and today? I'm here to fill you in. As always, we let the trolls troll, we let the haters hate. If something doesn't play out immediately, they go crazy and start typing in the comments. But let's get right into it. So on Friday, we had that downgrade, and I showed you what happened on in the downgrade in 2023, and I showed you what happened in the downgrade of 2011. In both of those cases, the market dropped at least 5%. In 2011, we dropped 10%. In 2023, was kind of this gradual meandering that eventually ended up minus 10% before rallying again. Now, of course, the market doesn't have to drop on the same day. That's not how the market works. The market is a liquidity machine. On Monday's retracement, this was the biggest volume ever in the S&P 500, the biggest retail volume ever. And those buyers, at least in the short term, just got trapped. So the market isn't going to drop just exactly when you expect it to, or rally exactly when you expect it to. It's going to build liquidity for these moves. Now, this coincides with some more bad news. And what is that bad news? The 20-year bond auction was today, May 21st. Now, the reason that this was bad news is because this was considered a weak auction. I've seen some people call it absolutely disastrous or terrible. The bid to cover actually wasn't that bad. So let's break this down. The high yield was 5.047. Some sources say 5.1, meaning this is what most of the bond buyers were demanding from the 20-year auction. And this was the highest yield in 2 years. Bid to cover is just a metric of desirability or demand. Usually for the 20-year, we hover around 2.57, 2.6. So this was a little weak, but it wasn't disastrous as we've seen failed auctions before. However, why is this the case? Well, it's because the spending bill is very close to a House vote. As a matter of fact, they may vote on it as early as the end of this week, but more likely experts are saying it will likely be in early June. Now, this right here, in my opinion, the timing of this is an absolute mess. So just real quick, before we get into the stocks, because I promise I'm going to get into some trade ideas and the charts for you towards the end of the video. But what the government was hoping for is that they would implement their tariff policy, that yields would come down, and then they would introduce this spending bill. So far, the tariffs are a disaster rollout, right? With the government having to put in place 90-day pauses and reprieves and all that. And secondly, rates, while they were coming down, right after Liberation Day, they soared. The 10-year was below 4. We were at 3.8. We are now at 4.6. So the administration wanted to cut spending. Remember Doge and all that. Even if there were good intentions, they wanted to cut spending drastically, bring yields down, fire a bunch of federal workers, cut the bloat. Instead, it seems like they just half-assed all of that, didn't really implement those things as much as they wanted. And now they are looking to introduce a spending bill that will likely add $4 trillion to our debt. And if that's not enough, what's going on in Japan with their bonds is crazy too. This is sort of like looking like a potential worldwide bond blowup. The 30-year government bond has hit an all-time high in Japan at almost 3%. This is not great because this signals that other bond markets are feeling jitters, but also Japan is the largest holder of US treasuries. So if there is some sort of blow up there, they need liquidity in order to pay off whatever leveraged situation they're in. And if they hold US treasuries, which are some of the most liquid assets in the world, what happens if they start selling off those treasuries to cover their debts? So today, Bessent met with the finance minister of Japan to make sure that they're aligned on foreign exchange rates as well as treasuries. So back to the markets. What impact is this going to have in the short term? In the long term, I could tell you, as I told you in my last video from Sunday, it's pretty obvious, right? The path that the US is on is unsustainable for the long term. $36 trillion in debt, running a forever deficit, just continuing to add to the debt. 125 debt to GDP ratio, that is unsustainable for the long term. But in terms of the market, right, in the short to midterm, what does that mean? It means that we are likely due for a pullback in the short term. So if you review my technicals from the last couple of weeks, this divergence between NQ and ES, or the S&P 500 on the left, NASDAQ on the right, you can see one is making a lower high, the other one's making a higher high. Very interesting that this is happening around the 2025 opening price, meaning the first price of the year, on January 2nd on futures. You can see that we tagged right into it on the S&P 500. NASDAQ is a little above it, another form of divergence. We were also 4% down from all-time highs on the S&P 500 before that rating came out. And in 2023, before the 10% drop, we were 3% away from all-time highs. And I was saying that it is not unprecedented to be so close to all-time highs and yet suffer a pullback or a correction. However, we have seen a wave of rapid buying, and I've been sharing with you the various breadth thrust indicators. Might be a record now for how many breadth thrust indicators have been triggered. And as I said, I do not think that we revisit these lows in the short term. I mean, if we get a recession in a year or two, sure. But I'm saying in the short term, in this cycle, I don't think we revisit these lows unless we have material effects of the recession on the ground. And I told you guys, look out for Target's earnings. Target reported earnings today, May 21st, and they definitely whiffed on earnings. And they did talk about tariff risks. And they said, we're not ready to raise prices yet, like Walmart, but that could be the last lever that we have to pull if this keeps on going. So if we switch over to the SPX chart, the S&P 500, and not the futures, I think that, as I talked about, this gap between May 9th and May 12th, this is a very likely target for the S&P 500 and will put us down about a 4.5% to 5% correction. If I pull up the moving averages, you can see that this is also where the 100 and 200 moving averages are. And moreover, if this 50 crosses above the 300, in the last 10 years, this has always signaled more upside, and we've never revisited a low after that has happened. So definitely watch out between the 50 and the 300 moving average. But I definitely think this minus 5% correction is a very likely pullback, and that is a pullback that I will look for some of the stocks that I talked to you guys about in my last video. And by the way, I also told you that I think gold will rally from here after that announcement of the downgrade, which was right here, and gold is now up nicely since then. And I think gold continues to make a new high. So not only did we get paid handsomely on puts, but what am I looking at here? I'm definitely looking at non-tariff related stocks like Meta, for instance, on these pullbacks. Another stock I talked to you guys about last video, and in prior videos, I told you that I expect Google, after breaking above this fear candle, this is the candle where Google dropped 7% on fears that its iOS search volume was dropping. Once we crossed above that, I told you that I think Google will rally from here. It is trading at a 17 PE, by far the cheapest of the Mag 7 stocks. And Google just released its new feature on its search, its new AI feature. Go and watch Google's I/O conference. They talked about how they were going to tackle the challenges that everybody sees with their search, meaning that these LLMs or chatbots will replace Google search. But moreover, Google Waymo now does more rides in San Francisco than Lyft. And Google only has 300 Waymos. Lyft has about 45,000 drivers in San Francisco, and Waymo does more rides than Lyft. So not only is it right now the leading robotaxi company in the world, YouTube has a valuation that is on par with Netflix, especially if you include YouTube TV. It is the third leading cloud services platform in the world, with Google Cloud reporting a 30% increase in cloud revenue year over year. And their search volume and search revenue is increasing, not decreasing. And I expect that these integrations with AI will only make that better. So in my view, it's only a matter of time before Google is trading in the 190s. I definitely think Tesla is tradable on this pullback until that June robotaxi event. You take a look at all this rabid buying volume and accumulation here. In my opinion, Tesla's definitely a buy on pullbacks to get to that 370 level that I talked about as the initial target. And personally, I think it cracks the 400 level at least by the robotaxi event. I also noticed that today there was a $10 million order placed above ask on the 350 calls expiring January 16th of 2026. And I really hope that SOXL can fill this gap so that I can grab more shares. We grabbed SOXL at $7 and change and are up over 100% on this position now. But if we can fill this gap here, or at least fill half of this gap, then I will definitely be adding SOXL to my long-term portfolio for sure. If you want the full list of stocks and options, exact strike prices, the exact time that I'm doing all this, link is in the description below. If all you care about is long-term, there is a much more affordable tier. I think it's $35 a month right now, which is crazy, based on all the analysis that you get. So just to recap, yes, in the short term, I do think that we're just going to get a little pullback. I do think the tax bill is going to be signed, the spending bill. I personally don't think this is a great thing for the country long term. I don't think that rising yields are a great thing for the country long term. I don't think the debt or the debt to GDP ratio is. And the great thing about the tax bill and the spending bill is that we actually have precedents for this. In 2018, which oddly enough, there's so many parallels now to 2018, the last time that we had tariffs, the last time Trump was in office. We signed the tax bill officially on December 20th, and we saw a 7% rally. But then that was followed by a sell the news event, and we had a 10% correction thereafter. So I do think that if this decline is short-lived, to be frank, I would really love to get down to the April 22nd to 23rd gap. I don't know that we hit that yet. But if this rally short-lived, we see a bounce from this level. There is a lot of consolidation at this level. There's a lot of demand at this level. There's been a lot of buying this whole time, especially by retail. If that tax bill gets passed, yeah, I do see a path that the S&P 500 can then trickle to all-time highs by the summer. And at that point, once the 90 days are over with the tariff pause, who knows what's going to happen with regards to that? Is the White House going to completely abandon it? Are they going to put their foot on the gas and push forward with the tariffs? Are they going to remove the baby tariffs and put in the large 100% tariffs once again? I have no clue. I don't work for the administration. I actually don't think they know. But if you're up a lot here because you own a lot of stocks, especially if you've been watching the videos and you got into some of these stocks and are up 30, 40, 50%, and you feel like, you know what, the bond yields, the tariffs, all this uncertainty, I'm just tired of it. I'm just going to sell and sit on my hands and see what happens. To be honest, you would not be unreasonable. If you look at the valuation right now, the current valuation of the S&P 500, we're in the 95th percentile at 22x. If you look at the NASDAQ, we're almost in the 95th percentile at 27x earnings. So we are in a very high valuation environment now. And if it makes you uncomfortable to hold so many stocks with these valuations, everyone's risk tolerance and time horizon is different, and we get a pump after the tax bill is passed, then yeah, I would not begrudge you if you sold or trimmed or whatever. Everyone makes their own choices, but I'm just putting the information out there for you. I hope you appreciate the analysis. If you want to follow every single stock and options play, and you want to day trade live with me every day, I day trade NASDAQ and S&P futures live every single morning. Link is in the description. Would love to have you. Leave a comment down below. Let me know what you're doing. Are you holding on to your stocks? Are you getting ready to buy? Are you not touching anything? Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.